trading statements from FTSE 100 firms last week, we've got another 5 coming up in the week ahead, plus a good smattering of macroeconomic news. Top down, it's going to be important to watch out for the following. December inflation figures from the UK on Tuesday the 17th. Remember that the headline consumer price index rose 1.2% year on year in November. The publication of the latest Beige Book in the US on Wednesday the 18th. Now that's a collection of economic anecdotes, if you like, and they can actually influence US monetary policy. The Federal Reserve next meets on the 1st of February, and also watch for the latest interest rate decision from the European Central Bank on Thursday the 19th. So that's the top down. Bottom up, keep your eyes peeled for these potentially informative statements. An operations review from FTSE 100 miner Rio Tinto on Monday the 16th, trading update from luxury goods firm Burberry on Wednesday the 18th, and a seasonal statement from Royal Mail on Thursday the 19th. But for me, the corporate update which could really cause a fuss in the week ahead is the third quarter statement from British Land on Thursday the 19th of January. Now, shares in the FTSE 100 property developer, which is technically a real estate investment trust, or REIT, well, they've never really recovered from last summer's vote to leave the EU. Though if you step back and look at, say, a 3-year chart, you can see that the shares actually peaked a year before the vote in May 2015. Doubts have been lingering over the underlying strength of the UK economy ever since, and while Brexit has boosted the FTSE 100 overall, that's because exporters and overseas earners have gone tonto, helped by the weaker pound, which has either boosted their competitive position as exporters or increased the value of foreign profits and assets, or both. Neither applies to British Land, the clue's in the name, which has lagged as a result. You'll also remember there was a terrible flap immediately after Brexit when several property investment funds either closed to redemptions or lowered their valuations, or both. Now that didn't last long. Most, if not all, are open to trade again and valuations have been adjusted back, but it will be interesting to hear what British Land has got to say. The firm owns, manages and develops retail, leisure and office sites in London and around the UK with around 29 million square foot of space. Key properties include London's Leadenhall building, known as the Cheese Grater, Sheffield's Meadowhall shopping centre and the mixed-use Paddington Central development. The key metric to watch when we look at this statement is going to be the occupancy rate, which was 98% at the end of the first half, with a weighted average lease length of 9 years. Besides those numbers, look out for comments on leasing activity in terms of square footage and how the rents compare to the levels at which net asset value, or NAV, was previously calculated. At the first half stage, British Land had leased or renewed 769,000 square feet, with rates an average 11.6% above the estimated rental value, or ERV, and 60% of those deals had been done post the referendum. Now, boss Chris Grigg may leave it there. British Land doesn't tend to comment on NAV per share at the Q1 or Q3 stage, but if it does, the first half figure was at 891 pence compared to 639 pence share price today. So that discount to NAV suggests the shares may be cheap, but equally it suggests the market's still worried about what Brexit might mean for the UK economy and therefore the value of commercial property. Let's see who's right. And as a final point, note that British Land pays dividends quarterly. The run rate for all 4 last year was 7.09 pence a share, but in Q1 and Q2 the figure was 7.3. 4 of those, or 29.2 pence, equates to a 3.4% dividend yield. The next graphic, by the way, shows the history of the quarterly dividend payments back to 2008, and the final chart looks at the annual payments over the past decade, complete with consensus forecasts for the next 2 years. As you can see on the annual dividend, there was a dip at the time of the financial crisis, but the recovery since has been healthy, and analysts expect modest, if further increases. Thank you for watching, and I look forward to seeing you next time.